Hey, this is Sebastian with NFM Lending. Thanks for watching another video. This is a video on the path to home ownership. How does the home ownership process work? How can you become a homeowner? And what do we as a lender look at when we're trying to approve you for a mortgage? So make sure you subscribe to the channel to get more content just like this on how to become a homeowner and home buying tips. And make sure you comment below if you have any questions. I'm here to help. At the end of the video, if you still have some questions, feel free to go to sebastianhomeloans.com and schedule a free consultation with me where we can go over a plan to help you become a homeowner. Now, some of the things we're going to talk about in this video are renting versus owning. What are the benefits and cons of each? How do they compare? The home buying process and exactly how it works. A pre-approval versus a pre-qualification. This is an important topic that not a lot of people understand the difference between the two. The 5 pieces of a pre-approval, the 5 things lenders look at when they're pre-approving you. That is credit, employment, income, which is also related to DTI, ability to repay, your assets and cash to close, and then the property status. So things like inspection and appraisal. Now, the other things we're going to talk about is monthly payment breakdown. What actually goes into your monthly payment on a mortgage? What is mortgage insurance and how does it work? Title and closing. So how does the title vetting process work? What does the closing table look like? How does that process work? And lastly, servicing. When you're actually a homeowner, how do you make your monthly payments? These are all great questions that we're going to go over in this training, so stick around. Renting versus owning. Which one should you do? Great question. So it really depends on your scenario, but typically there are pros and cons to each. Renting is, in a lot of experts' idea, only good if it's a short-term solution. The reason for that is because you're going to be wasting a lot of money renting. Now, if you aren't ready to qualify yet and you need to work on your credit, or you're moving to a new city and you're not sure about the area, maybe renting is a good short-term solution while you are able to get ready to purchase. But take a look at these numbers, and then at the end of the video, comment below to let me know if you think renting is better or owning is better, okay? So if you look at the example on the top right here, if you purchase a home for $390,000 and you put 5% down, even with a 7% interest rate, I want you to look at these numbers. Your monthly payment with principal, interest, taxes, and insurance is gonna be about $2,800 a month, and your equity that you're gonna build is about $59,000 after 2 years. Whereas renting at $2,700 a month, $100 cheaper, you're not building any of that equity, unfortunately. So something else that I want you to look at is the chart on the bottom, renting versus 5% down. Your total payment after 2 years with rent, $65,772 that you're not gonna get back. Whereas owning, you've paid $74,553 in 2 years. Now, out of that money, $7,799 has gone towards paying down your principal, which is also equity that you were building when you go on to sell that home later on, or if you need to take out a loan on that equity. Whereas renting, you don't get any principal paid. All of it is going towards interest, 100% interest, or paying off the owner of the home's mortgage. Now, your net cost when you subtract that principal paid is roughly around the same between renting and owning, but the biggest difference comes that the real estate value will appreciate over time, especially if you're buying in an up and coming neighborhood. It can appreciate even more than the national average, which has been roughly 3% over the last 80 years in the United States. Now, at the end of those 2 years, that is where we see that equity building up. That $59,123 is coming from you paying down your loan and the equity building with house appreciation. Home buying process, how does it work? Great question. There are 2 ways to purchase a home. Either you buy it with cash or you get a loan on that property, and that is known as a mortgage. There are 6 major parties involved in a real estate transaction: the buyer, the seller, the buyer's real estate agent, the seller's real estate agent, your mortgage lender, and the title company. Pre-qualification versus pre-approval. What's the difference? Great question. So a pre-qualification just means that a bank or lender talked to you, took down your information, maybe they did a soft credit check, and based on what you gave them, they say, okay, you're pre-qualified for around this amount. Now, what is the difference between that and a pre-approval? A pre-approval actually requests your documents like your pay stubs, your bank statements, maybe your tax returns, all that information that they use to verify your application. This is extremely important because the banks and lenders use very specific guidelines on how to determine your income and calculate your income. So someone who's self-employed, maybe their income on paper looks one way, but when applying to a loan, it could be totally different. And the same goes if you earn tip income, commission income, bonuses, any type of income that's varying. You want to make sure you're getting a pre-approval and not a pre-qualification. I get a lot of calls every month of people who were pre-qualified with a lender. Their contract fell apart because they weren't properly approved for that loan, and come to find out once they get the documents in, they are no longer approved for that price. So make sure if you are in the process of buying a home, you get pre-approved by a lender who is an expert in the field, and make sure they are calculating your income correctly. What are lenders looking at when they're getting you pre-approved? Great question. There are 5 pieces to a pre-approval. The first thing they're going to check is your credit. Then they want to verify your employment history. Next, they're going to look at your income and your ability to repay the loan. Fourthly, they're going to look at your assets and your funds to close. Where are they coming from, and do you have enough? And then fifth, they're going to look at the collateral. So anything having to do with the property, such as the inspection, appraisal, things like that. What are lenders looking for when they check your credit to approve you for a mortgage? Great question. So the first thing lenders are looking at is your credit. They want to make sure you have not only a good credit score, but a good credit history, that you don't have a lot of late payments, a lot of collections, things like that. So with a conventional loan, they follow the guidelines set by Fannie Mae, Freddie Mac, the governing bodies of mortgages. FHA loans, the difference between that and conventional is that FHA is sponsored by the Federal Housing Administration. So it's a government funded loan. They typically accept a little bit lower credit scores down to a 580, whereas conventional can only go down to a 620 minimum. A VA loan and USDA loan are also government programs. The VA loan is a loan specifically for U.S. Armed Forces veterans, and the USDA loan is available to anyone looking to buy a primary residence in USDA eligible areas. So it depends on where you are buying the home. The USDA and the VA minimum credit score requirement is a little bit more flexible. Typically, USDA will be 620. VA does go down to a 580. Do you know the truth about credit scores? So how does a credit score actually work? Great question. Listen, credit scores are not really for your benefit. They're for the banks. It tells the bank how likely they are to gain the full amount of interest they can from you. A credit score is like an adult report card that tells the bank how good you are at borrowing money and sticking to the terms that were laid out when you originally took that loan. That's why sometimes when people pay off car loans early, their credit score drops, right? You would think that'd be a good thing, but essentially you didn't stick to the full term, so it hurts your credit score a little bit. Now, credit score deems your credit worthiness and is still extremely important because for lenders, that lets them know how good of a borrower you are, and you are more likely to get a more favorable interest rate, more favorable terms, and much more access to getting approved for different loan programs. Credit Karma versus FICO. Have you ever seen the difference between the two? That's probably likely. So unfortunately, it's common that a lot of people rely on Credit Karma to know what their credit score is. Unfortunately, Credit Karma is not the most accurate. Credit Karma uses a different algorithm than FICO. FICO is what mortgage lenders use to determine your credit score. There are 3 credit bureaus, Experian, TransUnion, and Equifax, who are monitoring and reviewing your credit based on the information they receive from different creditors. So make sure when you speak to a mortgage lender that they are using your FICO credit score, because your Credit Karma is always buffed up a little bit higher so they can offer you different sorts of credit cards, personal loans. They want you to keep applying. Credit Karma is a marketing company, and unfortunately their credit algorithm that they use is not the same one as a mortgage lender's. What do lenders look for with your employment history? Great question. So the second thing mortgage lenders are looking for when they're verifying your employment history is they want to make sure you have at least a 2-year history of employment and that it's stable. That's the most important thing. So if you're hopping around from job to job, that's not a good sign for lenders. If you have a big gap in employment longer than 6 months, that is not a good sign for lenders. Now, something really important is if you're switching from a W-2 paying job to a 1099 paying job, you need a 2-year history of employment at that 1099 job. And the reason for that is because the income varies with 1099s. Same thing if you're going from a W-2 paying job to a self-employed position. Self-employed requires 2 years of employment history being self-employed with that same company. So if you had a company for 5 years and then you switch into a completely different industry and open a company, you're not going to be able to qualify. You need 2 years of history with that same company in that same industry. If you were switching from one company to another within the same industry, sometimes that can be allowed. It just depends on how you're paid and the length of time that you are with the new company. What are lenders looking for when they're determining your income, if it's good enough to qualify? Great question. So the first thing lenders look for is they want to make sure that you have what's called the ability to repay. They will make sure that they compare your income and your debts on your credit report to ensure that all of your debt cannot be more than 50% of your total monthly income. So for example, if you make $100 a month and you have a $20 car payment and no other loans, you can qualify for 50% debt $100, 50% is $50. If you have a $20 car payment, the remaining debt is $30. So that's how much of a mortgage payment you qualify for. This is the math that we do with bigger numbers. Something really important is that your bonus, your commission income, any type of income that it's varying, you do have to have a 2-year history of that income so lenders can take an average of how long you've been earning that. So if you get a $30,000 base, but $100,000 in commission, unfortunately, that commission will not be able to be used unless you have 2 years of history earning it at that job or in that industry. Have you ever wondered how much you could qualify for when buying a home? That is what the ability to repay calculation looks like. So this is an example of what I just went over, that we compare your monthly income to your monthly debts and make sure that all of your income has to cover at least 50% of your debts. So when you're looking at your debt to income ratio and your ability to repay, think about all of your monthly debts and the minimum payment on those debts. So car payments, credit cards, student loans, personal loans, things like that. You're gonna add up all of your monthly debt, and then you're gonna add up all of your monthly income. You're gonna take 50% of your monthly income, and then you're gonna subtract all of the debt that you have. Whatever amount is remaining, that is the mortgage payment that you qualify for. Have you ever wondered how much of a down payment you need when purchasing a home? Great question. So if it's your primary residence and you're a first-time home buyer, you only need 3% down for a conventional loan or 3.5% down for an FHA loan. However, if you're not a first-time home buyer, which means you've owned a home in the last 3 years, then for a conventional loan, you have to put at least 5% down. For an FHA loan, it's still 3.5% down. For a VA loan, it is 0% down. And for a USDA loan, it is also 0% down. Now, if you're buying a second home, the minimum down payment is 10%, but interest rates are going to be more favorable if you're putting 20 or 25% down. For an investment property, the minimum down payment is 20%. But interest rates are going to be more favorable if you put 25 or even 30% down. Have you ever heard of closing costs and what they are? That's a great question. Closing costs are costs associated with the purchase of a home. These are things like your title company fees, paying your first year of insurance, some taxes you have to pay the county, state, and government for the purchase of the home, and a few different things. Closing costs can range from $6,000 to $20,000, depending on the price of the home. It averages out to around $10,000 to $12,000 in total. In some areas, depending on your market, the seller can pay for some or all of your closing costs, depending on your loan type and purchase price as well. Included in your closing cost is something called prepaid items. Prepaid items are things you have to prepay to set up your escrow account. Things like your first year of insurance and a few months of taxes and a few months of insurance for the property in order to set up your escrow account and make sure that whenever you do have to pay your tax bill or renew your home insurance, there's going to be enough money in that escrow account to cover those expenses. So altogether, the cash that you need to close in order to purchase a home is a combination of the purchase price times by your down payment. So it's your down payment plus your closing cost, and that is your cash to close. Now, if you put an EMD deposit or a good faith deposit down, that is actually included as part of your down payment. So for example, if you need $40,000 at closing and you put a $5,000 deposit down at the beginning of the transaction, you only need $35,000 now at closing. So the fifth piece of information that we're verifying when we approve you for a loan is the collateral that the loan is going to be held on. In this case, the property. So we're going to verify that the property is, one, in good standing in the form of an inspection. So inspections are actually not required by lenders, but they are required for home insurance. And that way, if your home cannot get insured because the inspection is terrible, you cannot get a loan. As long as you have a loan on a property, you have to have home insurance because the collateral needs to be protected. So the inspection is usually step one right after signing the contract. The inspection is what makes sure the home is in good standing. You know, it's got good AC, good roof, no mold, no termites, things like that. It's for the safety and structural soundness of the home. Now, the second part of the collateral piece is the appraisal. That is something that the lender takes care of and we order, and an appraisal is done to make sure that you are purchasing the home at fair market value. We want to compare the home to other similar homes in the area, keyword similar, to make sure you are not overpaying for the home. So now that you've closed on your mortgage, how does the monthly payment work? That's a great question. So typically, once you close on your home, you get to skip the following month and your mortgage will be due on the first of the next month. For example, if you close your home loan in August, your first mortgage payment is not going to be due until October 1st. You get to skip September. Now, your mortgage payment will be due on the first of every single month. And what does it include? It includes something called PITI. That's it. So what does the PITI stand for? Principal, interest, taxes, and insurance. So unless you are waiving your escrows, which is something you can only do if you're putting more than 20% down on a conventional loan, your taxes and insurance are part of your monthly payment. There's a portion that goes towards principal, there's a portion that goes towards interest, and since it's a 30-year loan, in the beginning of your loan, a lot more of the payment is going to go towards interest than towards principal. There's going to be a big difference. But the longer that you pay that mortgage, the more balanced it becomes, and then there's going to be a point towards the end where you're paying more principal than interest. You can always make extra payments towards principal to pay down your loan early. Just make sure you verify with your loan company that you do not have what's called a prepayment penalty, where they can penalize you for paying the loan early. So confirm you don't have one of those before you close on your home. Now, how does the taxes and insurance get paid out on your loan? Great question. This is done in the form of an escrow account. How an escrow account works, it's basically like a savings account where your taxes and insurance payment on your mortgage goes to that savings account. It divides the total amount needed to pay your taxes and insurance at the end of the year by 12, and that's the amount they'll collect every single month. Now, when your taxes and insurance are due, instead of you having to pay thousands of dollars out of pocket, it just gets taken out of that escrow account and it gets paid for you. Your HOA and association, depending on where you live, can be collected monthly, quarterly, or annually, sometimes even 2 times a year. It just depends. That is not included in your mortgage, so make sure you are paying those separately. Have you ever heard of PMI or private mortgage insurance? Basically, what PMI is, it's an insurance to make sure that the homeowner is not going to default on the loan. So it's actually an insurance for the bank or lender. This is done so people don't need 20% down to purchase a home anymore. They can buy a home with as little as 3% down. But just to protect the bank or lender in case the home devalues or people stop making payments due to the high loan to value ratio, that private mortgage insurance is there to protect the bank or lender. On a conventional loan, the private mortgage insurance is only there until you pay off 20% of the loan compared to the value. On an FHA loan, the private mortgage insurance, or MIP, mortgage insurance premium, is on there for the life of the loan. You can only get rid of it if you refinance. A VA loan does not have mortgage insurance, and a USDA loan does have mortgage insurance for the life of the loan as well. What is a title company and what do they have to do with a home purchase? That's a great question. So the title company is the middleman in the transaction. Basically, what the title company does is it makes sure that the property is being transferred in a legal way and no liens are being carried over. They want to make sure when you become the new homeowner that the old homeowner didn't leave any loans or any debts tied to the property that could be carried over to you. The title company is the one that takes care of handling the survey, making sure that you submit your payment as the buyer and that the seller receives their funds for the proceeds of the home. The title company is an extremely important piece, and there are many title companies around that can help facilitate closing, as far as mobile closings, to have somebody come meet you like a notary or a mobile notary, or facilitate closings in their office as well. So how does the loan servicing work once you actually have your home? Great question. So about 3 days after closing, you're going to receive an email or a letter in the mail with who is going to have your mortgage. Sometimes the lender that actually did the transaction can collect the payments. Sometimes it gets sold off to a different bank or servicer so they can collect the monthly payments. After that, towards the end of the month, right before your first monthly payment is due, you're going to receive the instructions from the servicer on how to make your first monthly payment. This can either be done electronically, over the phone, or sometimes by mail, but it's not recommended just in case your mortgage payment gets lost in the mail. You don't want to have a late mortgage payment. If you have any questions, please feel free to comment below or go to Sebastian Home Loans and we can set up a one-on-one consultation on how you can become a homeowner. Thank you so much for watching. Make sure you follow me for more home buying tips.